Welcome, Professor Péter, Ákos.
Thank you very much. Good morning, ladies and gentlemen. My job is to talk about the big picture, and it will be related in some respect to what we have heard from Christina. The topic I'm going to talk about is a little bit the history, the path that leads to the present. Path dependence is, part of every process, and mostly the industrial structure related to digitization. And then conclusions and recommendations for decision makers. Now, being a Hungarian speaker, I'm not going to sell my country. It's not a PR show. So the statistics give us opportunity to look at the challenges and the hurdles and the problems also. Some of the problems is history, and I start from the process of convergence or catch-up. It's very natural in society to compare your lifestyle to the level of development, your wages to your neighbors. We never compare our wages to our neighbors in Romania. We do compare our neighbors in, say, Austria. And then the psychology, which I think is natural, but also I have reservations about its rationality, sends a message. There is some sort of convergence in the region we are talking about. Hungary is part of the region. The regime change which took place 25, 30 years ago found us at a level of, say, 40, 50 compared to what we call now European 28 GDP per capita. And as you can see, there has been some convergence, could have been faster, and the Hungarian story is a little bit sort of thought-provoking since the convergence has been pretty slow. And that also means that the level of development, wages, technological standards, are pretty far from the average represented by, say, Italy, and much far away from Germany or Austria, not to mention, say, Luxembourg. But we are not neighboring. We are not neighbor to Luxembourg. We are next door neighbor is Austria. So this is the challenge. This is the gap. This is the gap that is having an impact on the way we think about the economy. So this is the starting story. In spite of the level of development, the Hungarian industry has been doing pretty well. Now, we heard about the national government's program to increase the share of industry, reindustrialization. I have mixed feelings about it. I like industry. I like industry very much. They're close to my heart. But I do notice, and this is the statistics I quote from the central bank, the Hungarian National Bank, Magyar Nemzeti Bank, produced 2 weeks ago a report on competitiveness, competitive report. And you do notice that the high-tech component of the Hungarian output, which was interestingly enough above European average and much above the Visegrad V3 or V4, with us V4, without us V3, average has been on the decline. So more emphasis of industry is fine, but if this increase of the share of industry does not contribute to value added and also the complexity of products, then that's a trend that should not be followed. Still, the Hungarian industry's complexity, high-tech component is pretty high, but still, I sense some tendencies. Now, we have to, of course, admit when we speak about the Hungarian industry, we have in mind Mercedes-Benz, for instance, and the mentioned companies that open their doors for this night, and we have a problem exactly. And Christian pointed out with the SME sector. The SME sector in Hungary is not that productive. It's an interesting story because if you look at the German cases or the UK or Sweden. Small micro businesses and medium firms, small businesses and smallish businesses are not necessarily less productive. But in case of Hungary and some other countries, being small means you are much below the national average. And the national average is low enough, but the smaller the company, the less, the lower the share of the value added. So this is a challenge. And this is a challenge, and that's why we have to look at all the drivers and shapers of economic policy that may help the smaller businesses to grow. The statistics, again, borrowed from international sources, will give a thought about the convergence, and certainly it's going to be a very, very long time. The National Bank report points out some of the problems, and the problems are partly to do with finance, but mostly with human capital, let's face it. Now, finance, human capital, investment, technology. The Hungarian story is unique in a sense that the investment volume, which grew fast before the financial crisis, suffered a setback after the financial crisis, that's right. But you can also see the volatility of the figures. And the official figures indicate some sensitivity to EU funding. That's also unique, uniquely Central European and uniquely Hungarian. Investment activity is very much a function of EU drawdowns. Last year, 2016, the EU money slowed down, and we immediately noticed in the macro figures the GDP only grew 2% last year, is going to be growing 4% this year, so 2 to 1, just because, or mostly because of EU funding, and hence the decline in the investment activity. This is bad news. The good news is that 17 is going to be a strong year again. But of course, for the economy as such a volatility is a handicap, because it's very hard to adjust to such volatile flows of funding. Now, the level of investment is important, because new technologies do require investment. And if you look at the Hungarian components and the European level, the business investment in Hungary is 14% of the GDP, not that bad. It's all right. I borrowed the statistics from the European Union's most recent report, European Agency's report on investment activity in the region. And if I compare to the European average, the Hungarian private sector investment is pretty good. What is standing out is that the households are less active in Hungary, and then the state is much more active. So we have an active state. We Hungarians sitting in the room know about it. The Hungarian state is pretty active, and the private sector is all right, typically driven by foreign major players and multinational, transnational companies. And then the household sector, which includes the micro businesses, are below the European average. Now, this is the broad picture, and also I have to add the foreign direct investment component. EU monies are drivers, of course, and also the driver is foreign direct investment. And you can see after the financial crisis, that's pretty natural, there has been a decline, and also what can be seen is the component, the sources of funding, the intra-EU funding and the extra-EU funding, including Japanese, Chinese, and other investors. Well, I'm a bit worried about the amount, because, of course, the FDI is not the sole source of dynamism, but let's face it, it's very important in the region that is embarked on a convergence path. Now, if you can take one more critical respect, this is the productivity. The labor productivity is an issue. It's an issue in the United States. So it's a universal story that compared to the 60s, 70s, 80s, productivity growth has been a bit sluggish, and the Hungarian story is not much different. If we take, sorry, it's 05 and 14, so it's a decade. There's a typo in the title. The annual growth 2005 to most recent figures indicates that some countries, Poland, Slovakia, for instance, but also Romania and the Baltic countries have managed to increase productivity pretty fast. The Hungarian productivity growth is less than 2%, which is around the European average, but that's not something that I think is enough for us. The construction story is a little bit outlier, and let's face it, it's very hard to measure the productivity in construction, particularly when small firms and tiny firms don't report their output and labor use properly. Now, digitization. That's been the past, and let's talk about the present and the future. If we look at the measures we typically use to understand the situation in Europe and in Hungary, there's some sort of measure that measures the components and the overall level of digitization by components. For instance, the public sector, whether it's modern enough, or the internet use in society, that's something to do with society, while this is something to do with the public sector. Human capital is human capital, including, of course, the capacity to read and write, use computers, speak foreign languages and others, and connectivity. That's something to do with technology and access to broadband and other important components. Then you can see that the Hungarian trend is promising, but still behind the European average, EU 28, and that's all right. That goes without saying. All nations of the region look like that, but it's always interesting to look at the components of measure, because the overall place is a bit too general. If I look at the components of this performance indicator, then I spot two problem areas. One is the public sector, and the second is how to integrate the existing technologies and the technologies in the pipeline. The use of internet is above the average. I notice in my classes when I talk to my students, they use internet while I speak, so there's no problem with use of internet. Connectivity is at the European level. Human capital, let's face it, is a bit below the European level, and we spend our active life in education, higher education, that the educational system and other drivers of human capital are, still have a room for improvement. So my strong statement is that everything points out that the Hungarian state must do something, because the gap is the widest between the European average, the moving average, of course, and the Hungarian reality. Now, new technologies. Do we need the same technology as an Austrian or a German or a Swiss firm do? And the answer is not obvious. Of course, in the short term, you may say that no, we don't need that much because the wages are lower. And with lower wages, certain technologies are just not rational, not economical. because, well, there's a labor. And then we, particularly speaking here in the western part of Hungary, we know that this is not true, even if it looks like true, because first the wage tendency is upward. So the gross wages in euro, of course we don't use euro, but that's another story, so the value depends on the exchange rate. But if it translates into euro and take Austria as some sort of benchmark, the wages are shockingly low. But first, the trend is upward. Second, availability of labor is an issue. And even if the wage level would remain below the Austrian and German for decades to come, still the availability of labor to be found in this part, at least this part of Hungary, forces you to think as seriously about digitization, modernization, use of modern technology and labor-saving technology as much as in the West. Still, it's something we have to keep in mind. I'm talking to our guests because we Hungarians know perfectly well that the wage level has been kept pretty low, and it's only recent years that wage increases started to reach the double digit, which is a challenge, of course, in the short term for companies, particularly for small and medium-sized companies, because you still remember my previous charts, these are the companies that are not competitive enough in terms of value added. So for the same wage increase is a minor challenge for a large company and efficient company with high productivity, but can be a very serious challenge for medium and small businesses. Now, location. And the location is very important. If I look at the map of Europe before the financial crisis, 2000 to 2008, and the blue is good in this case, the high growth. And the periphery from Iceland, Ireland, Spain, not much Italy, Greece at that time, and Central Eastern Europe plus the Nordic periphery has been growing pretty fast, and part of Germany was not bad, but not as fast as on average Central Eastern Europe. Now, after the financial crisis, 2008 to 15, the picture has changed a little bit, except for Central Eastern Europe and for Hungary, because as you can see, our next door neighbors are doing pretty well: Austria, Germany, Poland, Romania. And that's very important because everybody knows that number one foreign trade partner for Hungary is Germany, their export partner. I'm not sure everybody knows who is the second in Hungarian export. Romania, and third Austria. So if you look at the map, this is what economists call the gravity model. The markets that are big and growing fast and close to you are important. Markets that are a bit far away, like China, are less important. China, Russia is not among the first 10 countries of our export. Import is different. Russia, both Russia and China do count. Now, I'm just going to attention also to the inner country differences. You cannot probably see, but we have seen in previous presentations the map of Hungary and innovative and open and dynamic firms. If you still remember, most happen to be in Transdanubian part and the north of Dunai város, so to say. And what is below it is, let's face it, not much activity, and what happened to Nokia, for instance, meant to shock some region. By the way, the Nokia story is part of the reason why Hungarian high-tech indicators look less promising. Now, my major message is that location is important, and the Hungarian location is very, very good. And this is a gift in some sense. Also time zones, this may sound funny, but time zone is one of the assets of the Hungarian economy. shared service centers that function in Budapest and outside Budapest, employ 80,000 people, nearly as many staff, probably near 80% of the automotive industry. And the reason is because the educational system is still all right, and second, because we are in the proper place. Now, these are the facts, and now I stop here, and myself looking forward to understanding the challenges and the answers provided by experts. We at the university do research on the same topic, and myself looking very much forward to hearing the new trends. We try to understand the fast-moving processes. If you look at figures, you identify problems, and the problem is that the Hungarian SMEs are still, even if they're interested in the new technology that we heard, that's very good news. But if we just look at the hard data, they are still a little bit behind. You may say that the Hungarian general public is a bit conservative. It may be true, although, but the good news is that if something changes from the top or from below, the Hungarian society is pretty adaptive. Those living here remember the introduction of cash registers, which is obvious in Western societies, but was a big revolution sort of in Hungary, and that's been absorbed to the economic reality pretty well. And also the trade control system, which GPS-based technology, very important for the tax office and the authorities, has been adopted without, well, too huge shocks. So we are behind, but we are ready to learn new tricks. Challenges. I wouldn't call it a problem, but can be a problem, brain drain. I call it a challenge because we lose in inverted commas, young talented people to foreign companies' markets, but they may come back. And then the Polish example or other examples indicate that inflow and outflow of talented people is part of life. So it's unlike 100 years ago when people migrated from Europe to the United States, never come back. Right now the brain drain is a threat, but also is something that can be managed in case there's a local dynamism in society and high wages and good opportunities. So where shall we start the modernization? It of course comes from the business, comes from the trading partners and partners that share the same métier, same business, but also must come from the state, because the state plays a pretty high role in all Central Eastern societies, particularly in Hungary, and this state can influence the structure in many ways. One is, for instance, incentives. I'm much happier to read in the news that the shared service center settles in Budapest rather than a new tire producing company produces tire. I'm nothing against tire, it's all right, but it's it's not certainly a high value added component, and it takes too much Russian gas to import from Russia. It increases our dependence on Russia. On the other hand, if we can invite a research center to Hungary, employing 1,000 engineers, my heart would be warmer. So we have a lot of room for smart economic policies and also smart localities, because economics, now we have to admit, is local. Even in a small country, there's a huge gaps between the southern and the western, eastern parts. In the capital city, the Budapest-Vienna axis, and 30 kilometers away from the highway, you can see still the remnants of the 80s. So that's why the dynamism comes from below and also must come from the top. Let me just stop here and thank you for your kind attention. Looking forward to the research results and the research. Thank you.